Bitcoin plunges to near $62,000 as the AI trade unwinds, HYPE falls 14%. The consensus read is already outdated. What matters now is the second-order effect most commentary still ignores. We will map trigger, incentive shift, and downstream impact before the close. That's where Bitcoin just landed after a sharp sell-off that nobody saw coming quite like this. But here's the thing, this isn't just about Bitcoin falling. This is about what just broke in the architecture of the AI hype cycle, and why that matters to anyone holding tech exposure right now. 3 months ago, the narrative was bulletproof. AI is the future. Bitcoin benefits from AI adoption. Tech stocks rally. Everyone wins. The mechanics seemed airtight. But last week, something shifted. Sentiment reversed. And when sentiment reverses in crowded trades, capital moves fast. Let's ground this in what actually happened. HYPE, that's the AI-themed ETF tracking companies directly exposed to artificial intelligence infrastructure and deployment, just dropped 14%. 14% in a single correction tells you the scale of unwinding happening right now. That's not a healthy pullback. That's capital recognizing that the AI trade got ahead of itself, and it's repositioning. Now, Bitcoin's correlation to that move is the instructive part. 2 years ago, Bitcoin barely reacted to tech sector moves. Today, Bitcoin is moving like a risk-on asset again. It's bouncing with growth stocks, falling when growth stocks fall. That's because Bitcoin has been repriced as a leverage vehicle, a bet on continued expansion, low rates, and risk appetite. When growth stocks correct, Bitcoin corrects harder because it's the tail of that bet. What's the actual trigger here? The data suggests this. Institutional money started questioning whether AI capex growth could sustain itself at the pace everyone priced in. Nvidia guidance looked solid. Data center order books looked solid. But the math on return on investment for those AI chips started looking shaky. If you're spending billions on H100 clusters and your revenue growth from AI inference isn't accelerating as fast as the capex, the ROI thesis breaks. And when ROI breaks, the whole trade recalibrates downward. Here's where this gets granular for investors. The AI trade was never really about artificial intelligence working or not working. It was about the speed of adoption and the willingness of corporations to spend on infrastructure before they fully understood the payoff. That's a classic case of front-running, capital betting on the direction before the fundamentals prove it. And front-running always reverses when the crowd gets too crowded. You're seeing that reversal happen right now. For Bitcoin specifically, the downside from here hinges on one question. Does this unwinding stay isolated to the AI trade, or does it bleed into broader growth sentiment? If this is just a repricing of AI capex timelines, moving them from 2024 to 2025 to 2026 to 2027, then Bitcoin stabilizes in the $60,000 to $64,000 range and you've got a healthy shakeout. But if this is the start of a broader tech pullback, where growth stocks start re-rating lower, then Bitcoin has more downside to work through. The $58,000 level becomes the next technical support. The $55,000 level after that. What to monitor over the next 3 to 5 days? First, watch Nasdaq breadth. If tech stocks stabilize and only the most leveraged AI plays stay under pressure, that's bullish for Bitcoin stability. Second, watch the CRY, that's the Crypto Fear and Greed Index. If it drops below 30, you're looking at a genuine panic liquidation, and that usually means the worst is over. Third, track any commentary from major AI capex players, Amazon, Google, Microsoft, on infrastructure spending guidance. If any of them walk back guidance, that's a signal that the AI trade unwinding has more room to run. The contrarian angle here is worth sitting with. Every major correction in Bitcoin has been followed by a new catalyst that resets the narrative. This one will too. The AI story didn't break. The timing of when AI economics prove out just got pushed forward. That's actually healthy. It means the market is learning to distinguish between hype and reality. And that distinction, over time, usually creates better entry points for long-term conviction trades. This is worth paying attention to. Not because Bitcoin is crashing, corrections happen. but because you're watching the first major repricing of how fast AI economics actually move. That signal ripples. Watch it closely. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.